Today, threading the inflation needle will take more pain. Hello again, it's Martin North from Digital Finance Analytics, World Latest Posts covering finance and property news. Well, Warren Hogan, the Managing Director of EU Economics and Economic Advisor at Judo Bank, wrote an important opinion piece in the AFR which echoes what I've been saying recently. Australians may need to prepare for higher rates in order to get inflation grounded, because that narrow path to lower inflation is getting at very least covered in briers and other obstacles. He wrote, New Reserve Bank Governor Michelle Bullock's honeymoon won't last long if the recent run of data is anything to go by. Over the past 2 weeks, we've received several economic updates that suggest the rate hike is just around the corner. Stronger economic data and rising oil prices makes the RBA's forecasts from early August very difficult to achieve, particularly the December 2023 expectations. The national accounts revealed economic growth well above forecasts, with the annual rate at 2.1%. The RBA had 1.6% penciled in. The December 2023 GDP forecast now looks unattainable. To get the RBA's 0.9% year forecast, we will need a near recession over the back half of the year, with quarterly growth rates of just 0.1%. It could happen, but it's not very likely. The July monthly inflation indicator seemed to confirm the RBA's expectation for inflation falling to 4% by December, but the official data seems at odds with building evidence of renewed inflation pressures since July 1. We will need another small upward adjustment in the cash rate in the next few months if we are to remain on the narrow path. The Melbourne Institute's inflation gauge has jumped higher in July and August, taking the annual rate for both headline and trimmed inflation back towards cyclical highs in annual terms. The gauge is an imperfect indicator of the official quarterly inflation numbers, but so too is the monthly indicator from the ABS. Of more concern is the jump up in the costs and final prices indices in both the Judo Bank Purchasing Managers Index and the NAB Monthly Business Survey. Both of those services accurately predicted the peak and subsequent easing of inflation pressures over the past year. They are now pointing to a renewed lift in both cost pressures and final prices in recent months. The RBA needs the disinflation trend of the past year to continue if it is to achieve its forecast for trimmed mean inflation of 3.9% by December. The headline CPI forecast is 4.1%. The headline CPI forecast is looking particularly shaky following the surge in oil prices over the past 4 weeks. The RBA assumed Brent oil at $80 a barrel for their August projections. It's risen by almost 15% since, to be at $94 US late last week. And meanwhile, Australian dollar weakness has supercharged the impact on retail petrol prices, which are at record highs in most jurisdictions across Australia. He said, I paid $2.50 a litre the other day. The final nail in the rates on hold coffin is the ongoing strength in employment growth. The 65,000 increase in August was stunning and leaves the average monthly jobs growth in 2023 at around 40,000. This hasn't been enough to keep up with record working age population growth, which at 50,000 a month this year is the only reason the unemployment rate has edged up from 50-year lows of 3.4% to the current 3.7%. Higher unemployment rates might eventually alleviate wage pressures, but it is largely irrelevant for the economy's short-term growth trajectory. What matters is the people who have jobs and are spending. In the past 6 months, we've added 227,000 people to payrolls across the country, and that will increase spending power in the economy. Now, some will argue that these are relatively small misses from the RBA and that it is the 12 to 18 month forecast that really matter. And many will conclude that it is too early to shift those expectations. But he says, I disagree. The short-term growth and inflation trajectory matters immensely because the RBA has taken out no insurance against higher growth and inflation in its policy settings. A cash rate of 4.1% is the absolute bare minimum required to deal with the inflation challenge before us. Just about every other central bank has much tighter policy and higher interest rates. Even the ECB has caught up with the RBA in the past week. Our real interest rate is still deeply negative, and unless we get inflation down to 4% by December, the real rate will remain negative into 2024. The economy is navigating the cash flow shock to variable rate debt holders remarkably well. Employment is strong, and the property market continues to make solid gains. The mortgage cliff has failed to crash household spending the way most people feared, and consumption growth has slowed as desired, but belt tightening is only really hurting discretionary spending thus far. The strategic imperative for Australian monetary policy is to avoid having to take the cash rate to 5.5 or even 6% at any stage in the next 18 months. This is the real recession risk. That risk has grown, if only a little in the past few weeks, and will likely require a response from the RBA board. The risks for monetary policy have shifted in the past fortnight, but probably not enough for Governor Bullock to hike her first meeting as chair. They can wait for another employment report and the September quarterly CPI, but it is increasingly looking like we will need another small upward adjustment in the cash rate in the next few months if we are to remain on the narrow path. And here I think it's worth noting that Chanticleer recently took the argument even further, writing of Phil Lowe's passing out speech. Lowe, he said, was disappointed that the lessons had not been learnt and potentially that the RBA review did not explore the relationship between monetary and fiscal policy in more depth. And they went on to say, you are left with a sense that in a nation with a growing productivity crisis, with a housing affordability crisis, and an inconsistent approach to infrastructure investing, all issues raised in the speech, Lowe was advocating for a return to the pandemic model of Team Australia, where fiscal and monetary policy work together to solve problems decisively without the vested interests that he had previously bemoaned. Indeed, the fact Lowe isn't getting another term speaks to the fact Team Australia has fractured under the weight of rising interest rates, cost of living pressures, and concerns about inequality. Those forces were unleashed or worsened by those same pandemic policies Lowe celebrated. Someone had to take the blame for that, and that someone was Lowe. And as he said in the Q&A, the governor's job is to do the unpopular thing when required, and it cost him a contract extension. But in highlighting the demise of Team Australia in his final speech, Lowe may have inadvertently left corporate Australia with a warning. We're entering a tougher, less forgiving environment where financial pressure on voters is putting pressure on politicians to find heroes and villains. And your record is unlikely to save you. But my take out here is this complexity that we're entering. We are entering a time when inflation is not going to go away as expected, where interest rates are likely to have to go higher, but where fiscal and monetary policy is more and more disconnected, and the politicians, of course, are washing their hands of so much of the things they should be doing. And that is the problem. When you have political agendas that outweigh strategic agendas, you have a problem, which is precisely what Tarek Brooker and I discussed last week. We are, I think, entering the twilight zone as a result. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.